Good afternoon. My name is Dennis Wells. I'm with Wells Funding. We are here with Lisa and Martin from the Lisa Gaff team with Berkshire Hathaway Home Services Executive Group. We wanted to give you a quick market update, tell you about how things are going during this unique time period, and just wanted to give Lisa and Martin a moment to introduce themselves as we get started.
Hello, everyone. Lisa Gaff here with Berkshire Hathaway Home Services Executive Group. And we just want to say hello, and I hope all of you are well, and what a crazy time. But, you know, we kind of want to update you on the real estate market and what's happening, because some people think, oh, you know, nothing's happening, but it definitely still is. We are still able to provide you with the great service that we always have. It's just in a different way. And what's interesting is we have been implementing a lot of new technology and things that we're doing virtually. We've already been working on all of these things. Now we're really just having to put them into play. So we're real excited to be able to offer you a lot of great things coming up. We are still listing homes. I think the market is still good. We're just doing it virtually. So tomorrow, Martin and I actually have a video walkthrough with some of our clients who want to put their home on the market, and we can't really go there to show them what to do. So we're going to do that virtually through a video walkthrough. So we're real excited about that. Yeah, so if you have any needs or need anything, please just reach out. Martin, go right ahead. Say hi.
Hi. Martin Wells with Berkshire Hathaway Home Services Executive Group, part of Lisa's team. Sorry. Yeah, what she said, we're doing everything virtually now, and it's a little weird, but we're making it work.
Yeah, absolutely. So we're glad that you joined us today. We want to take a few moments, excuse me, talk about what's going on in the real estate world, and hopefully dispel some of the myths that are out there right now. You know, like Lisa was saying, real estate is still moving. People still need to buy houses. People still need to sell houses. Excuse me. So we're just looking for different ways to make that happen in a more virtual world. In order to keep everybody safe and you know, to get us quickly through this season that we've been in. So really quick, we always want to start off with news, what's been going on in the housing market. Some of this is, you know, going to be a little bit affected by the shelter in place, but currently we see that existing home sales have increased in every region of our country year over year. Overall over 9%, but in our area a strong 8.4%, and realistically probably the reason why we're not seeing more home sales than what we have is just that inventory is so tight. That's kind of the backstory of the crash of 08, 9, and 10 is that you had several years there where builders were not building. You had a lot of subcontractors that went and did other things and got out of the industries. So now it's harder and harder to get new product out there. You know, it's getting better than what it was, but that's going to be limiting the home sales. But that also means that there's strong appreciation that happens because of that. Another good sign is that the amount of your income that it takes to qualify or to make your payment on a home is really low. Historically, it's going to be about 21% of your income is needed to make your house payment. Right now, it's about 15%. Also, you have probably heard mortgage interest rates have been extremely low recently, and the projections are that they're going to stay low, if not move lower, throughout this year into 2021. And also, a lot of people think that you have to have super high credit in order to buy a house, but what we're finding is that you know, average credit scores on FHA loans are under 680, and you know, in the normal scheme of things, we can do FHA loans all the way down to 600. That being said, we've all been affected, obviously, by the coronavirus. That has affected, on the real estate side, how you show houses or how you do listing presentations and how you do client consultations. On our side, it's been affecting, lending because of a lot of uncertainty in the market, as well as, doing, video conference calls for pre-approvals and things like that. Obviously, the economy has been impacted by the shelter-in-place orders that we've seen over the last month, and obviously that's had an impact on unemployment. And so that's what we see right now. The big question everybody has is, where is unemployment headed? We had over 6 million people again file for unemployment last week, which was a new record. But comparing the recession of 2008 with today, you can see that in 2006, 2007, 2008, unemployment was starting to creep up, and then it maxed out in 2009. Whereas today, 17, 18, and 19, unemployment kept getting lower, lower, and lower. And all of a sudden there's the spike, which is just really related to the sheltering at home, the closing of restaurants and other, I guess, non-essential businesses that we really enjoy being able to take a part of, and we're looking forward to getting back to. But a lot of those people right now are in that unemployed mix. The real wild card is, how high unemployment is going to go. Goldman Sachs is thinking maybe 15%. The Congressional Budget Office is projecting 12. JP Morgan is projecting 8.5. And again, it's kind of a wide range. But one thing that everybody agrees on is that even though unemployment is pretty high right now, that recovery is going to be pretty quick. It's really, for those of us living here in the Midwest, it's really a lot like having a blizzard. Everything is still there. Everything's going to function. We just have to wait for the snow to melt, or in this case, to get the all clear to go out and be around people again. And once that happens, even though Q1 and Q2 are going to be pretty bad, Q3 and Q4 all the way into 2021 and beyond look really, really strong. We do look at the unemployment rate to reach the highest it's ever been since the Great Depression of the 30s, but quickly going back to under the 2009 peak and continuing to keep going farther and farther down. It will take a few years probably to get to the point where it was in January, but we are moving in that direction because our economy is generally strong, and there's a lot of opportunities for people. One of the questions that people have is, well, as unemployment goes up, what is that going to do to home sales? If there's higher unemployment, are there less people buying houses or less houses being sold? But when we look back at the data for over 20 years, we see that the unemployment rate and home sales do not have a symbiotic relationship. For example, in the late 80s and early 90s, even though unemployment was going up to 7.5%, home sales were going up at the same time. So, there were people that were, not working, but there were more people that were out there buying. Also, when the unemployment, went down and then went back up in the early 2000s, housing sales continued to rise. The only time that we find high unemployment coupled with a decrease in home purchases was right after the crash, and it's really understandable because that was the point where lending standards tightened significantly. Back at that time, they just weren't giving out credit as readily as they even are today. It went from kind of one extreme to the other, where everybody could get a loan prior to 2008. 2009 through 2013, it was much more difficult. And then what we find is, moving forward, 2015 and beyond, even though unemployment rate kept going down, housing sales stayed pretty steady. And again, that's really more than likely due to inventory. There were just a certain number of houses that were available. People were holding onto their houses a little bit longer. And you had more people that could get into houses than houses that were available, which has kind of spurred on builders and those that take houses and rehab them for sale. USA Today had a great quote. They said, in contrast to other recessions, the job cuts that we have now are the result of a calculated halt to the economic activity. At the time they wrote this, 36 states had issued stay-at-home orders. That's even more now. They're saying affecting 86% of Americans. Is probably 100% now, just because of the impact of the virus, and really looking at a national disaster area for the entire United States. But there's some good news. When we look at past financial crises, whether it's the Great Depression of the 30s, the Great Recession of the 2000s, or the current crisis, the Great Depression had several years of high unemployment. The Great Recession had 3 years of super high unemployment. We're looking at 2020 being it. Once we hit 2021, 2022, it's going to normalize. A lot of people also are concerned about the value of houses and what's going to happen because of the crash. And we do find that in 2008, when the S&P lost 51% of its value, that home prices depreciated over those 3 years, 2007, 2008, 2009. But that recession was really caused by the housing industry. Because of the subprime mortgage meltdown specifically, there were a lot of people that were not able to make their payments. A lot of houses went into foreclosure, which resulted in price depreciation. Our current situation is more like the early 2000s, when you have the dot-com crash and 9/11 happening pretty close to each other. Even though the S&P lost 45%, home prices appreciated in 2000, 2001, and 2002. Really, and they really appreciated at a strong amount. So that's really what we're expecting to happen through this time. And again, David Rosenberg says what 9/11 has in common with what's happening today is that this shock has also generated fear, angst, and anxiety among the general public. Back then, people avoided crowds as they believed another terrorist attack was coming, and they're really acting the same way today to avoid getting sick. And the same parts of the economy are being affected. Airlines, leisure, hospitality, restaurants, entertainment, all those discretionary activities have been affected by the COVID-19 in our attempts to really get a handle on that. But if we look back at the last 5 recessions, remember 2008 was caused by the housing crisis. The recessions prior to that, we actually saw housing prices and values increase. Even in 1980 and 1981, when mortgage rates were like 18, 20%, houses were still going up in value because people understand the importance of home ownership. And we really feel that's going to be the same way through this crisis. It's really supply and demand. There's still strong demand for houses. Lisa and Martin can testify that houses are still selling. They're getting on the market. They're getting accepted offers in one day, during this time period. And so everybody's still expecting that home prices, will continue to appreciate as we continue to move forward here. And, because, we really believe in housing, that's why, we wanted to do this presentation today and just kind of give you an update and be here to answer any of your questions. Any thoughts, Lisa or Martin?
That's great, Dennis. Thank you so much. I love the statistics, and I think that's what our buyers and sellers, for that matter, need to hear. So we appreciate you going through all of that. I think one of the main things I want to make sure that we convey to all of our clients is that we want you guys to be safe. There are reasons why we need to go ahead and put homes on the market right now. Some people think, well, they shouldn't be looking at houses, but if your financial stability is at stake, or there's an emergency, I just had a client who was moving across the country. Her husband got a new job. So there's definitely reasons why we need to get their homes on the market. And so we will keep you as safe as we can. We're putting sanitation stations in all of our listings, and we're doing things virtually as much as we can. So.
Absolutely.
Sound good, guys.
Well, thank you all so much for joining us today, and we'll keep you updated as to future opportunities for us to get together and give you more market updates and keep you up to speed with what's going on in the real estate world.
Awesome.
Thank you.
Thank you.
All right. Bye-bye.